Welcome everyone, and what a week it has been. We had tariffs, we had hot inflation, we had terrible retail sales, and through it all, the S&P 500 was up more than 1%. Now the market can't stay irrational longer than you can stay solvent. But now we have to ask the question, with the macro deteriorating, tariffs all but assured, and the consumer weakening, when does the market fall apart? And is it an opportunity to get long or to get short? And how do we make money in times of uncertainty? That is the question we will be asking and answering on this channel today, along with where do we stand with earnings, what smart money was doing under the hood that might surprise you, and my medium-term macro view of the economy based on oil, yields, and the dollar. Is this the final straw, and how concerned should we be? We've got a lot to talk about. Let's roll the tape.
Welcome everybody to the Daily Recap Show where we talk about stocks and the financial markets. My name is Chase. If you like this video, please subscribe, hit that notification bell as well as the like button and leave a comment for the algorithm. Let's get into it.
This is the daily heat map of the S&P 500, and US stocks edged slightly higher on Friday as the S&P 500 eyed a fresh record to cap a busy week of tariff hikes, inflation updates, and retail sales data, which pretty much all fell short of estimates. And it was a very red day today, except for here in technology, as well as financials, and even then it was only select names. For example, what held the mega caps up today was Apple and Nvidia, both up in excess of 1%. Apple showing relative strength the last couple of weeks, as well as Meta today up 1.11%. But the detractors to gains were Microsoft down 0.5%, as well as Google and AVGO down 1.17% as well. It was a very mixed bag here in financials as well. And then looking at commercial services or credit services, the only green name there was PayPal. Other than that, it was red across the board. However, when you dive under the hood into flows, you see a very, very sneaky divergence. You can see that the New York Stock Exchange actually saw net inflows on the day. The Nasdaq 100 actually saw net outflows. Now, we did see early inflows, which probably helped to boost the early names of the winners of the group, stuff like Nvidia and Apple. But then we did see outflows on the back of some of the bigger mega cap names, inflows in the New York Stock Exchange, a flat S&P 500, and that really goes to show that there definitely was some broad-based market buying occurring under the hood and some selling of the mega cap names, despite what the sectors overall will tell you. Now, yes, we did have XLC and XLK at the top, but there was definitely that rotation under the hood when you look at flows. Nonetheless, when we look at today and what we saw, it was the S&P 500 trading flatline, and then we had XLC, Energy, XLK, and Financial. So very cyclical stocks outperforming here today. Now, they were barely up. Like, for example, Financials was up 0.19%. There were winners and losers in each sector, but the biggest loser today was definitely gold. Gold, giving some back after a stellar run, and also some of the tariff news. And I was probably slightly less bullish for gold as a whole. However, the biggest loser here today was staples and financials. So XLP, XLV, the defensive components of this market, right, as well as real estate and utilities, were really sold off today. So, definitely a rotation we did see today out of defensives into cyclicals, into growth names, as well as the broader market, especially when you go back to flows. We definitely did see that part of the market exceed expectations. However, when you look at the factor and size segment, we only saw large cap growth and large cap core gain today. Everything else was flat to slightly down. Mid cap value was kind of flat. These zeros should really be in gray. I don't know why they're colored in red, but it is what it is. And then we saw like broad-based selling here in small caps, but it was nothing too serious. I really thought we were going to get another capitulation Friday. That seems to be the trend, but we didn't today. A little bit of selling, a little bit of buying, and the market net kind of flat. Now, the reason why we actually saw tepid price action today had to do with retail sales, and there's no two ways around this. Retail sales were a bit of a dumpster fire. I mean, look at the month-over-month headline figure, negative 0.9. That's nearly a percentage down from the month prior. The consensus was for negative 0.1. Retail sales control group, the one I like to look at, negative 0.8 versus 0.3 consensus. So yeah, retail sales was a bit of a dumpster fire. The market, I guess, kind of looked behind it. I saw a couple of commentaries saying that this could be the result of some of the wildfires they saw and seasonal adjustments. But nonetheless, retail sales still a bit of a dumpster fire, and we'll see if this improves throughout the year. And we'll look at other retail sales figures for the week. Maybe we'll keep track of the Red Book Index to see a more normalization with regards to this and how it pertains to the market. Nonetheless, not looking good. And I think this is part of the reason why we saw a lot of selling in the market. Now, the reason why gold actually didn't fare too well today was Trump's reciprocal tariffs. He signed a deal. He said officially around April 2nd, April 1st is when they're going to be implemented. Now, the reason why gold was down today on tariff news was because Trump, during his campaign, focused on universal tariffs, but this idea has been de-emphasized for reciprocal tariffs. And I guess it is the only fair way to do it. If you're going to charge me a 2% duty, I'm going to charge you a 2% duty instead of a 3% duty. So look, Trump definitely in that mood for negotiating. He's not coming in strong and hard and staying on that path. He's coming in strong and then leaving room for negotiation. At least that's what we're seeing. That's what the markets are telling us. And that's why we've seen a little bit of a resilient market today. Globally, it was very mixed. Now, Trump met with the Indian Prime Minister yesterday. India was an absolute dumpster fire today. And that's because India gave Donald Trump everything he wanted. I mean, if Donald Trump's in the room and he says, you do this, you do that. China was very, very green, but Europe was mixed as well. Canada, North America was mixed. The US was slightly green, Canada red. South America was kind of bullish. Just an all-round very mixed day globally. And that's coming off what has been a pretty, I guess you could say, good week for global markets nonetheless. But let's look at some market movers. Airbnb stock was up nearly 15% following better than expected quarterly results. They beat on top line, beat on bottom line, raised guidance, very interesting. And the company also laid out plans to expand its vacation platform into an app for everything related to travel and living. They're going to spend $200 million on that. So they're looking for growth drivers to continue. I still think after this run right here, the stock is pretty cheap. And I think this is going to really help the stock go higher if management can execute. Now, NVIDIA was up 2.6% today. Huge mover, but this wasn't the story of NVIDIA. NVIDIA released its 13F today. Now, NVIDIA's 13F showcased a couple of new buys. One of them was WeRide, a Chinese autonomous vehicle provider. Now, on the back of NVIDIA investing $57 million into this company, they were up 80% today. Absolutely huge move. Another new addition was Nebius Group. They were up 7% on the NVIDIA news, and NVIDIA is officially out of their serve robotic position, and serve is down 40% in a brutal action. So Jensen Huang and NVIDIA really moving this AI high beta part of the market. However, guys, for everything we saw today, there were only 3,200 advances, about the same decliners, slightly less decliners than advances. That's what you want to see. This is what healthy market price action looks like. And then we finally recaptured all of the moving averages, market momentum looking solid, the shorter term, longer term, and medium term averages looking very, very strong. Otherwise, guys, any volatility we do get, like I always say on this channel, buy the dip. Now let's hop on the charts. Now the S&P 500 this week was up 1.03%, pretty much 1%. Let's go ahead and add the Qs onto this list. We'll go ahead. We'll also add the RSP, the IWM, and we'll add the Dow Jones as well, just to see where we stand for the week. And as you can see, the S&P 500 up 1%. The Qs were the best performing asset here, up 2%. And the Qs for the Nasdaq 100 generated extreme alpha relative to the rest of the market. And then we kind of saw a very trepid week here. The RSP was up ever so slightly. The Dow Jones was flat and the IWM was down to 1%. Now, a lot of these losses stemmed off the CPI move we saw here. The Nasdaq 100 was quite resilient in the face of the inflation data. Higher beta in the RSP wasn't. Now, we did actually see a clawback to the upside to pretty much finish the week flat despite hotter than expected inflation data and retail sales. Nonetheless, the place to be this week was certainly the Qs. And that's actually a very, very strong week. And when you look at it year to date, we kind of see a very similar story. However, the Dow Jones is actually pretty much equal with the Qs. The S&P 500 up 4.29% for the year, the RSP up 3.64%, and the IWM lagging. So we're seeing very much the same trade we saw last year, right? Where the Qs were leading, the Dow Jones and S&P 500 here in second place, followed by the RSP and then the IWM. So, and sort of back to the same market dynamics that we saw last year. Nonetheless, I mean, the IWM up 2% for the year, the SPY up 4%. We're 6-7 weeks into the year. You take those gains as they come. Now let's actually dive into the S&P 500, guys, and look at where we stand for the year. Let's go to the candles, and very, very interesting trade. Now we officially formed a doji up here. That's not a good sign, especially at the core resistance. Now yesterday I did say that we would come down from this level. We need to use it as resistance. That's exactly what we did, and this is a very, very ominous candle. You don't like to see that. That's a very indecisive candle at the top end of the range. Probably means that if bears don't take us up and above early in the week, it's going to be a pretty ugly week. We probably move lower. You can see the S&P 500 was pretty much flat today, but we were up at one point a lot. Then we came down and then we sold off into the day. The Nasdaq 100 was the best performing sector today, up 0.38%. And then everything else were pretty much mixed. Look at small caps, look at mid caps, kind of flat, slightly down. Now, what really did help the market today, I guess, was yields. Yields fell, the dollar fell, bonds gained as a result, and then gold and metals as a whole was down 1.52%, silver down 0.67%, and the market just sort of giving some back, I guess, just digesting all of the gains we saw here in the week. That's to be expected going into the weekend. We are also going into a long weekend. President's Day is on Monday, so the market won't be open. But for the S&P 500, we're at the top end of the range. The core resistance did not move up, and that probably means unless we actually break above and use it as resistance, make the move higher, see the gamma flip move higher, I think we'll probably see some downside early on into the week next week, especially with this candle right here, and especially at the top end of this range. Nonetheless, I'm talking about short-term moves. We might see a little bit of a pullback here on Monday, shorter-term moves, but you do have to understand that we are pretty much at all-time highs. We may have actually gone and made an intraday all-time high in the S&P 500, and there is nothing more bullish than all-time highs. Now, the Nasdaq 100, it actually closed at an all-time high. Yes, it did. That is an all-time high closed for the Nasdaq 100. That's bullish. And into the next week, guys, very similar situation, unless the gamma flip moves up, right, or we break above it and hold, I probably see some downside into Monday, into Tuesday. Nonetheless, that is an all-time high closed, and you remain consistently bullish when you see this type of price action. When you look at our zones, we are in positive gamma. Yes, we are at the top end of the range, but that is extremely bullish price action when you look at it. The RTY, doing exactly what I said it would. We bounced off the gamma flip like I said it would on Wednesday, and we've made our move onward and upward. All we want to do is target the core resistance and then make our next move over and above. It's been a very, very strong resistance area. We've used it multiple times, as you can see. All we need to do now is push up to this level and go from there. Otherwise, you want to be buying all forms of the gamma flip, looking for upside. We're seeing a very, very cool consolidation right here. And I think a break to the upside is coming sooner rather than later. Looking at gold, we saw a little bit of a pullback. It's actually good. It's good to see this. I mean, we could pull all the way back to like this level right here, 2,700. Like we could draw a rectangle and have this massive range right here. If we pull back to like sort of like this area in gold, it would still be very, very healthy. So we pull back right here, consolidate. That would be a higher low in a very key zone when we use it as resistance a couple of times on multiple occasions, had some consolidation here. I guess you could call it support, and then made the next leg up. And then from there, we can go ahead, break this high right here, and that would be trend continuation. So if we see continued momentum in gold to the downside to as far as possibly 2650, do not be surprised. That's to be expected. That's actually healthy market momentum. Looking at Bitcoin, it continues to just trade in this range right here. It's just digesting a whole bunch of last
last year's gains. And to be honest, I don't blame it. I mean, look at last year's consolidation period. It pretty much went from like, I would say, early, late February all the way to November. That's a 9-month consolidation right here. And then we made the next move to the outside. So do expect continued consolidation here in Bitcoin. However, I would be biased at the low 90,000, looking for the 120, 130 level before the end of the year. That's how I would do. Now, guys, let's actually talk about some individual stocks I do like. Now, Evolution, guys, in the last 5 days, if you look at the stock, right, on a percentage return basis, the stock is actually up like 9.12%. Over the last 2 weeks, I've been saying that this stock is a buy, up 9% here in the last week. And I do think it's going higher because we finally bottomed here. Fundamentals for this company are amazing. All the stock needs to do is go ahead, break that level right there, and then onward and upward. And I think we go see something like $100 very, very quickly. This is a turnaround play, a contrarian play. Keep this position small, pays a 4% dividend yield. They're buying back about 3% of the shares outstanding for the year. You love to see this type of stuff. Another stock that I really do like right now is Uber. It's showing relative strength, right? We probably are going to consolidate at this top end of the range, but I think we see $100 before the end of the year. And again, another stock that's sort of fallen out of favor, not many people like, is PayPal. I think this is probably where you want to buy the lows, right? And we probably go ahead and close this gap at the $88 level. We'll probably do that before the next earning. If you're looking forward to generate alpha in individual names, those are the names I would look at, particularly Evolution. I really like the valuation there, the fundamentals there, but I think all three of these names should outperform into their next earnings next quarter. And then for individual ETS names, you guys know I like the S&P 500, the Nasdaq 100, the RSP, and then the S&P 600. So this is where I would keep, if you're looking to index, that's where I would put your money. But guys, we're going to see a lot of volatile price action tomorrow. However, any dips we do get, like we did here, and here, buy those dips because we are going to continue to make all-time highs in the S&P 500 and the Nasdaq 100 looking ahead for 2025. I've been very consistent to buy the dip. Had you done that, you'd be sitting very, very pretty on gains this year had you bought some of the volatile dips we've seen, as well as some of the dips we saw here earlier into the year. So guys, take advantage of any dips and volatility and simply be patient. We will move higher. Fundamentals support that. The macro supports that. And now the technical is also supporting that. So buy the dip.
And let's talk about sentiment. This is the AAI sentiment survey, something we went over yesterday, guys, and something I just wanted to go over again today, because where sentiment is right now, looking at this and what the markets are doing, particularly over the last, I would say, month or so, year to date, it simply doesn't add up. And this right here is simply telling us to buy any dips and maybe just stay long, because normally when you see sentiment revert from these numbers right here to something like this, 47, maybe mid 40s, early 40s, something like we saw right here, that's going to coincide with some form of a thrust up. So guys, sentiment looks kind of fearful, looks very dire. In my opinion, this is where you want to get incrementally more bullish, especially when you look at some of the stats we see for earnings season. Now, these are my stats. These are Tom Lee's stats. He works at Fundstrat and he sees a blend of actuals and estimates here. Fourth quarter earnings estimates at 17.1%. Now, take this with a grain of salt. My data says 15.2%. Nonetheless, we are seeing a huge beat, relatively speaking. And just for the record, coming into this earnings season, the estimate was for about 9.7% in earnings growth. So if Tom Lee's estimates are correct, and we'll see as earnings season goes on, we could be looking at a situation where we could be beating by 1.8, 1.9, maybe even 2 times if Nvidia comes out with a huge beat. That is going to set equities on fire, particularly US equities. However, that is earnings in the past. What are we looking like in the future? And we do know that for 2025, we are expecting about 14% earnings growth. Now, normally we actually see revisions to this number as the year goes on. And this is the median revision we see, typically what we normally see in the average year or median year, I should say. But this is what we saw in 2024. And this green line is where we are right now in 2025. So we are tracking a little bit below 2024.
2024's revisions well above the median revisions, this bodes really, really well, especially as the year goes on, especially as earnings. With all that said and done, revisions looking robust, earnings looking really, really good. What has the S&P 500 done lately? And if you just look at it, it's done absolutely nothing. We've traded sideways for the better part of the last 3 to 4 weeks. And actually, when you look at it from mid-December, we've kind of traded sideways. We are kind of at a stone's throw away here from all-time highs. However, we have seen a pretty robust move here in 2024. And now we sort of are just consolidating. And this really goes to show with where valuations are right now in the market. In fact, that we've seen such a huge beat in earnings and it hasn't coincided with a huge move to the upside. That really goes to show the environment we're in, not just the earnings environment or the valuation environment, but also the geopolitical environment. And such type of environments where the S&P 500 has consolidated in light of great earnings generally only occurs about 13% of times. Again, going back to 1950. Now, sometimes they do indicate market tops, stuff like 2008, stuff like 2022, and other times in the 1990s, we see tremendous rallies ensue. This type of consolidation with where earnings is right now is either a top signal or a bottom signal. Now, this is what we want to see. Historically, you want to see the market definitely break that range. You want to look for a close that exceeds the range by plus or minus 3%. Logically, the market will continue in the direction of the break. And typically speaking, if we break to the upside, this is what we can see in the S&P 500. However, if we break to the downside, this is actually what we can see. So this consolidation period right here, you want to draw support lines, you want to draw resistance lines. And if we make a definitive move to the upside or downside, that's very likely where we're going to go. So the S&P 500 is at a critical zone. And I think what's really going to determine where we go is simply the macro. And more particularly, I think these three indicators is going to be a huge driver of what the S&P 500 does over the next 6 months and for 2025. And they are the big three: the US 10-year yield, the dollar, and US oil or crude prices. And the big three generally move in tandem. And when they go up, it can be seen as risk off. And when they go down, it can be seen as risk on. The big question is always which ones are leading and which ones are lagging. And the answer to this question, guys, can change over time. On short time frames, you tend to find that if one of the three gets out of line, the other two generally drag it back into correlation. We saw this in December when oil got out of line, and in early February when the DXY or the dollar got out of line. And this appears again to be happening with the 10-year yield. Since mid-January, I've been saying that I think the dollar has topped, and this is still my base case, guys, and this is really the foundation for pretty much every other market I look at. From my point of view, the US 10-year yield did freak out a bit, as you can see right here, especially after the CPI report on Wednesday. However, the dollar and oil are generally still trending down, which should help drag the US 10-year yield back down, all else being equal. My overall stance is that we are in the early stages of a medium downtrend for the big three that started in mid-January. Laggards among the big three are now being dragged down instead of being dragged up. Positioning in the dollar is still at historically extreme levels, and I think this is mostly due to tariff fears, but also due to the global rate differentials. Yesterday's CPI/PPI print pushed market pricing of Fed rate cuts to just one cut in 2025. In some instances, you could argue for zero. And I still think the tariff fears are somewhat overblown because Trump seems to be more on a negotiating mood more than he was in 2016. And so I still think it is very possible for the Fed to cut more than the market expects in 2025, especially if we get the rent and shelter deflation that I expect to see in the market. Now, there is still no real signs of dollar long positioning being unwound just yet. When and if the DXY breaks past its prior low, this 107 area right here, it could lead to a cascade of dollar long positions being unwound. When and if this cascade occurs, I do not want to be under allocated to risk assets because it's going to be very, very good for risk assets. We are likely to see a rapid injection as well of hundreds of billions of dollars in liquidity entering the market. between mid to late February and early April. I spoke about this with regards to the Treasury general account in Tuesday's video. Go ahead and watch it if you haven't already. And this is a tailwind for the DXY. Generally speaking, this is a DXY inverted. If the dollar moves down, we should see liquidity move up as well. When you get a weaker dollar, more liquidity, and the other two assets act in tandem, US Treasuries move down as well, and oil moves down as well. That's going to be really risk on for stocks and equities. So in the here and now, guys, buy the dip, because I believe the consolidation we're seeing in the S&P 500 right now is going to break to the upside. Now let's talk about data and earnings for next week. Now, again, we have a pretty big week of data, but not as big as the past week. On Monday, we just have one Fed speaker, Fed Harker. Then on Tuesday, we don't really have much of anything. NY State Manufacturing, that's pretty much it. Then on Wednesday, the biggest is building permits here, housing starts, month-over-month, year-over-year figures. We get the mortgage rates, and then we get the FOMC minutes. Then on Thursday, again, we get initial jobless claims. That's about it. I mean, Philly Fed manufacturing, but it's not really a market mover. And then on Friday, we get the PMIs. This is the biggest data of the week, as well as existing home sales year-over-year, month-over-month, and Michigan consumer sentiment. And then earnings next week, the biggest company reporting in terms of market cap is Walmart, followed by Baba, Bookings Holding, Arista Network, Medtronic, Melli, Analog Devices, Constellation Energy. So less of these mega cap names and more of these higher beta names. A lot of energy names reporting, a lot of software names, staple names, China names reporting. So guys, be prepared for volatility. Guys, Block is reporting, Oxy, interesting names reporting, very high beta, sort of these smaller mid-cap names reporting, Vici Holdings, very interesting. So do be prepared for high beta volatility. But if you've made it up until here, thank you so much for watching. If you like this video, please subscribe, hit that notification bell, as well as the like button, and leave a comment for the algorithm. Cheers.